Welcome back to another edition of Primary Source China Investment. We're on show M. Peng.guo and I are excited to be here. We just wanted to take a minute on this Memorial Day to acknowledge all of the great men and women who made the ultimate sacrifice for this country. And with that, we're going to get into China policy. And this week, we're talking about China opening up. If anybody's been following the financial news, this week it was announced that Goldman Sachs and ICBC formed a joint venture for their wealth management business. Similarly, BlackRock signed a joint venture with CCB for this wealth management joint venture. So everybody was commenting that this was a great sign of China opening up. I tend to be a little bit more discerning when it comes to these kind of articles about opening up, because the first joint venture actually occurred between Guotai Junan and Allianz. That was more than 2 decades ago. So why are we still doing these joint ventures? Perhaps it's because the opportunity is just too big to ignore.
Yeah, that's a great question. And firstly, welcome back. China is really the big market. So just to simply check the size is really too big to be ignored. The joint venture, I think from the market perspective, it's more like to serve the Chinese people internationally or global asset allocations needs. It's not designed to feed for the foreign investors, or because they don't have the branch, they don't have capability to provide such kind of a service. I think that's probably the major reason to push to start the joint venture to do it.
That's an interesting concept. I look at it a little bit differently, because finance and investment is still a restricted industry in China. You know, just like agricultural, mining, farming, transportation, education, healthcare, legal services, and of course, information technology. Those are all restricted industries. There's also a prohibited industries, which includes things like internet services, news, tobacco, fishing, publishing, books, stem cell research, and others. You cannot be in that business in China. So if you're saying it's from the demand side that these JVs come out, I'm saying it's actually from the policy side that these JVs, it's the environment in which you're allowed to operate.
Especially in such kind of the environment, you have to partner with some local companies, because the cost is too high before you reach the break-even point. So that is a lot of the companies choose the joint venture. Obviously, the finance area is a highly regulated area.
Yeah, I think the way to break through that is, if you look at the automobile sector and you look at Volkswagen was the first joint venture in China, and that was 4 decades ago. And the only company to break through that was Tesla. And the reason Tesla runs its own company on the mainland in China is because they demanded it and had the technology to do that. So until somebody really steps up with sort of a new mousetrap, I think the era of JVs is not going to go away. So if you look at these Goldman Sachs announcement or the BlackRock announcement, those companies can run their own businesses on the ground in China. And Goldman is, I think, bought 100% of Gaohua Securities or something like that. So they're moving towards that. But this idea that China is opening up really has to be tempered against the reality of what companies are allowed and not allowed to do on the ground.
I think allowed and not allowed is really like the black and the white. So this is no question about that.
Yeah.
From the asset management perspective, it's like all the bigger companies go to the private fund market. They already set up the branch. They run whatever strategies in China market. And that looks like there's no problem. The cost is much lower to doing that.
Yeah, that's why it's interesting that Goldman goes this joint venture for wealth management when they can have their own wealth management entity on the ground. Maybe it's for distribution, but I did want to get to one other point before we ended this. You know, look at banks. The biggest bank, the biggest foreign bank in China is HSBC, and they have a grand total of 170 branches. Compare that with Agricultural Bank of China, which has 24,000 branches. This is not a level playing field. There's no way that HSBC can compete with these huge branches with massive distribution and a huge footprint. The other thing I wanted to mention is there are industries and products that are just run by local Chinese companies. If you look at smartphones, digital payments, cargo ships, wind turbines, foreign firms are basically excluded from that market. So again, when we say China's opening up, we really have to think about what that means in terms of investment. What are the companies that are going to benefit from that? Are they local on the ground companies, or are they international companies that are doing business in China?
I think that's a great question. So that is the one thing you just see the result. So it looks like there's no foreign company in that. So it's really like the supply chain. And so they might not run the business directly in China, but through the supply chain, they probably already participate and get the most of the, not most of it, is their whatever profit they deserve in the China market. Most of the time, it's much higher than the local Chinese companies, their profit margin, and the risk is much smaller than the local companies. Local Chinese firms take a lot of risk. And secondly, a lot of things is not driven by the China capitals, not government capitals. A lot of capitals from the international capitals. So that you will see that VC, private equity is very hot in the China market. So a lot of them came from the United States. All the brand, all the technologies, they came to this market, they can compete with each other. So that means most importantly, they need to streamline internal and external partners to smooth align the entire process. That is a key thing for their business success.
Yeah,
I think this like joint venture and partnership is very important.
Yeah, that goes to your point about operating your business on the ground. You know, sort of from the bottom up, you have this investment, and you have risk takers that are willing to invest in Chinese businesses on the ground or their own business on the ground. And then you have this top-down issue, which is what business can you operate on the ground? I think it's a good place to stop today, but this opening up is very important for people who want to do business on the ground, but also for investors who are looking at China to see what are those businesses that are going to benefit from licenses that are required on the ground, operating entities that are on the ground, and the entrenched local names that are actually winning business on the ground. So today on Capital Markets, we wanted to circle back to commodities and commodity volatility. If you've been following the news about literally any commodity, the prices are really accelerating quickly and then coming back off a little bit. And China's taken some very aggressive steps to enter into the market to try to control prices. And some of the things they've done is they've told banks, stop issuing products that are wealth management products that invest in commodities. And also, if anybody's caught speculating in the market, there's going to be fines and penalties and things like that. China entering the market for these large commodities, such as copper, which is mined globally and used globally, it's a very hard position for the government to take, given the size of these markets. So it'll be interesting to see what happens going forward in terms of price, demand, and supply.
Right now in the commodity market, it have 64 commodities. So it's really like the big market. It's good enough to create the commodity index fund and run the commodity related index like the future products.
I wanted to go back to one other thing that we've talked about in the past, which is follow this uptrend. And in the commodity market, we're going to show a few commodities like coal and gold, and show that and oil to show that when you do catch the uptrend with an overlay, you're going to improve your risk-adjusted return. And this is the key here. I mean, coal in China is the largest fuel, despite all the talk about ESG and those kind of things. Coal is still the biggest fuel in China. So the return is actually pretty good, but if you catch the uptrend and have an overlay, you're going to have a much better risk-adjusted return. And we'll put some charts up there.
Great. So if you see the summer coal from the index, so the Sharpe ratio is 0.7, and the annualized return is 17.6%. This is the best performance of the commodity. But if you capture the uptrend, the annualized return would jump to the 33.4%, and the Sharpe ratio is as high as 1.8. So this is much better than the original index if you get the uptrend. Similar things for the crude oil. in the China crude oil, they have only 3 years in the market. The annualized return is negative 5.85%. The shock ratio is 0.17. So if you capture the uptrend of the crude oil, the annualized return is high as 36.76%, and the shock ratio is 1.66. So that is much better than the original commodities. So this should go back to the original index investment. Just simply capture the uptrend of this commodity index, you will get a much better risk-adjusted return. So this is also like the too big to be ignored. In commodity market, I think is probably will be the biggest market, biggest commodity market in the world. The reason is quite simple. China is the largest manufacturer countries, and they consume the product a lot. Yeah. For example, like the thermal coals, they consume like the 3 billion tons of the coals. And in China commodity market, from government perspective, in my understanding, they don't have no interest to jump into the market and play or control and stimulate speculation in this market. It's more like the government want to keep the reasonable price range, similar like the currency. So they want to get the stable market. Otherwise, all the downstream small companies, individuals, they all get screwed up.
Yeah, they
so that is they cannot afford such volatility. So the government is most likely from stable perspective. So whoever participates into this market, they try to make the short-term, quick, large amount of money in short term. So that's speculations always push the price, get the higher volatility to doing that. So as soon as the price beyond the bottom line of the government, you will see the government will immediately take the actions.
Right.
Keep running like that.
Right. But if you look at a commodity like copper, you know, the CEO from Freeport-McMoRan was on, and they're the biggest producer of copper on the planet. And he's saying there's new sources of demand, there's new sources of supply. China may not be the center of the universe for copper in the near future. And given the fact that China does want to make sure that the price of copper is stable, they really don't have a lot of levers to pull on a global product that's priced in US dollars still.
Yeah, I think a commodity from the whatever I see, the China research, most of the time is still tied to the Fed. So Fed is they have they print so much money. Obviously, commodity market get out of control. Correct. And the copper is like the international commodities. So nobody really can control the copper or like the crude oil, such kind of things. It's naturally driven by the market.
So I want to get your opinion on investing in a CTA strategy right now. You know, CTA has been very, very hot. It's been pretty consistent. The returns have been pretty good. I would say it's an asset class that has become more and more familiar to high net worth individuals. So what would your thoughts be on a CTA strategy right now, given what's happening on the supply side and demand side?
Yeah, CTA is quite a popular strategy in China. So pretty much all the companies, they talk about CTA. The main reason is CTA can provide a kind of the similar like the fixed income, because every day they make a small amount of money, they accumulate over the time. As the yield curve looks like steadily upward. So yeah, that is people trade like the kind of the fixed income to take it. And also CTA volatility is much lower than other strategies. That's the people like it. And also due to the high frequency tradings, it also generates a lot of fees for the future companies. And that is the major reason for them to marketing the CTA strategy as well as expand to the institutional client.
Well, I think there's a lot to watch in the commodities market going forward. We're going to leave it there this week. Thanks for tuning in. Make sure you subscribe, leave us a comment down below, and we'll get back to you. Have a great long weekend.
Thank you.